they were able to go down there and get ultra cheap power, which we can talk about later, with very inexpensive land. And then because you have this unregulated power grid, they could do demand response where they could actually cycle down, sell their power back to the grid in areas when it was underserved. And so it was really basically a perfect environment for Bitcoin mining.
What's up, guys? This is an amazing conversation. Today, I have James Davolos. He's a portfolio manager at Horizon Kinetics, and we get into something that I've been wanting to talk about for a very long time. There is this brand new thing that's happening down in Texas. We have old world economy like oil and gas coming together with Bitcoin mining and all the AI data centers. That's right. This is going to be something that dominates headlines and becomes the talk of both Wall Street and tech in the coming months and years. And so I went and I found someone who's heavily involved, really understands this stuff, and wants to explain it to us. And so James does a great job of walking us through what exactly is going on down in Texas. How do these companies work? What is going on with getting the gas and the oil out of the ground? How do we use that for Bitcoin mining? And how is that going to impact things like artificial intelligence, the data centers needed, and where the world is headed? This conversation is full of all sorts of insights that you probably can't hear anywhere else. So I appreciate you guys listening. Here's my conversation with James Davolos. James, I thought a great place to start this conversation is it feels like there is this brand new thing that is happening down in Texas where we have an emergence of oil and gas and kind of the old world. We've got Bitcoin mining and we've got these new AI data centers. And it feels like it's like the merging of the old world, the new world, and we're almost getting a peek into the future. You all at Horizon Kinetics are now kind of at the forefront of this. And I think that you guys were at the forefront of Bitcoin mining. You guys have been at the forefront, I would actually argue, of kind of land development, oil and gas, et cetera. Help me understand, how did we get to this point where now oil, gas, land in Texas is actually going to help us drive kind of the future?
Yeah, great question. I mean, obviously, it's not that intuitive that you would have these old oil fields, which are functionally deserts in the middle of nowhere, that now might actually end up being the high-tech hubs of the U.S. and the world. But if you look at the prescient moves by Bitcoin miners, what attracted them to West Texas was a couple of things. So you have an abundance of cheap land. You have an abundance of cheap power. You have an unregulated power grid. So ERCOT, which is an interstate power system in Texas. And then now you actually have a new dynamic, which is you have cheap cooling. So they were able to go down there and get ultra cheap power, which we can talk about later, with very inexpensive land. And then because you have this unregulated power grid, they could do demand response where they could actually cycle down, sell their power back to the grid in areas when it was underserved. And so it was really basically a perfect environment for Bitcoin mining.
So take me, let's start with just the land and kind of the environment. So you said that these are oil fields that basically are like deserts. If I was to go visit one and I walk out onto the land, do I even know that there's oil under the ground? Or am I just, it appears on the surface looking at empty land and somebody smarter than me is going to come and dig and drill and eventually find the oil?
So I'll tell you a great story before I get into that. But so if you remember back during the heights of COVID, when they had these tracker maps about what counties, the most red one had the most cases per capita, and then the lower red had fewer. And this is during one of the massive waves, and the whole country is just bright red. Then in the middle of the core of the Permian Basin, Loving County, the best oil wells in the world, it's blue. The reason why is that I think there were 3 full-time residents in Loving County.
Wow.
So it's literally nothing. So you would walk out, and if you weren't on let's say you got off of the highway, you might see oil rigs or oil derricks dotting the skyline. But other than that, you would think that you were in the desert or on Mars. So you would have no idea where you were.
Got it. And so when that oil was originally found and started to be extracted from the ground, it was all purely oil and gas kind of related. There was no computing. There was no any other use case. It was just classic capitalism and economic incentive. There's oil under the ground. If we go get it, we can sell it and make money.
Yeah. So actually the real beginning of this oil era of West Texas started in about the 1950s. And that was your simple pressure well. So that's where you basically go down into a pressurized deposit. Pressure takes the oil and gas up to the surface. Super simple. That production peaked in the 1970s.
Okay.
Fracking came along in, call it 2010. And then they realized that fracking was a major development, maybe around 2014. So that second iteration of fracking brought the second boom of Permian oil, but with it, so you're going down, not only are you fracking, so breaking up the rock to release these hydrocarbons, you're also going horizontally. But this has large byproduct of both water and natural gas liquids. So that natural gas and natural gas liquids is extremely valuable for power generation. So you don't really use oil for powering a power plant. You use it for mostly for transportation, for petrochemicals, things like that, some middle distillates. Gas, on the other hand, is what goes into most of America's power generation from these combined cycle steam plants. One of the really interesting aspects about these wells is that they're drilled for the oil economics, not for the gas. So if oil's $85, they don't care if gas is at $2 or $8.
Do they monetize the gas right now?
Yeah, great question. So a lot of the wells in the Permian, if you do not have a pipeline to get your gas out of the basin, either down to Houston or up to Henry Hub, there's another hub called Waha, which is much less valuable. Your gas is almost worthless. And so when you hear this thing flared gas, so it was actually more expensive to transport your gas to a basin or store it than to just light it on fire. And so this was a big problem for the environmentalists and the industry where, you asked earlier, if I'm walking around in the Permian, would I even know if oil's there? Well, if you were there at night a couple of years ago, even in certain areas today, you'd see basically all these bright lights like Christmas trees where they're flaring off their gas.
And the reason why they're burning it versus just letting it escape into the air is what?
It's actually more carbon intensive. So that's called venting. That's really bad. You are not supposed to or allowed to vent. So that's where you just literally let your methane release into the air. It's actually better for the environment to burn it versus just venting it.
Got it. Okay. So now we've basically used fracking, a couple other different methodologies to go. We found the oil. We're going to extract that. We're going to get that out and we know how to monetize it. There's gas. That gas is either flared or it is moved to a power plant.
Yes. So it can if it can get egress, it's probably going to Henry Hub or it's going down to Magellan. Magellan is the hub in Houston. In Houston, it's probably going to get liquefied and put on a liquefied natural gas vessel. And it's going to be sold either in JKM for Asia or Rotterdam, which is, a theoretical transfer hub in Europe.
Now, is that part of why I saw a chart recently that said the United States for the first time in a long time, or maybe first time ever, is a net exporter of energy versus being a net importer?
Yeah, that's a huge driver of that because we produce far more gas than we can consume. So when you see an LNG export facility like Freeport have outages, like they've had more times than they should, it destroys the natural gas market because now you don't have enough storage. And so if we have more gas we're getting produced, you're over injecting in the injection season. And now you might actually have a situation where you're full and you have to curtail your natural gas production. So that's why you can see gas at $2, $3, $4 in different parts of the US. And then over the past couple of years, you've seen 200 or 300 equivalent prices in Europe and parts of Asia. So that's a huge part of the U.S. being fully energy independent, plus the fracking boom, where the U.S. is, depending on how you calculate it, if you include gas liquids, the largest oil producer in the world.
How much of the focus on the Permian Basin and kind of this West Texas, oil boom, if you will, is because there's oil and there's not that many people that live there versus actually there are deposits like this in many places in the United States. It's just maybe, in areas where there's so many people that it wouldn't be possible to go and get the oil.
Great question. And so the geology of the Permian is very unique. It's two ancient seabeds. Now, there are other shales in the United States. None are nearly as prolific for the oil. There's a phenomenal gas shale, the Utica and the Marcellus, which is in western Pennsylvania around Pittsburgh. It stretches down into West Virginia, and that's where you've seen a lot of community backlash around the drilling. And so, one of the biggest advantages of the Permian, particularly in the Delaware Basin. So the Midland Basin has Midland, Odessa. They have some communities. Once you get out into Loving County, Reeves County, Culberson County, and the Delaware, there's no population to worry about. You've had some seismic activity, and obviously you still have environmental issues, but this is very important for facilitating oil and gas development. And it's going to be equally, if not more important, when we start talking about data centers and their derivative uses.
Got it. And now where does Bitcoin mining come into this? Is, my understanding is, okay, we're flaring off this gas. Bitcoin miners show up and say, well, actually, why don't you just give it to me? And now I don't need to transport the gas anywhere. I can turn that gas into power and on site, right at kind of the wellhead, if you will, go ahead and just mine Bitcoin. Is that too simplistic of a view?
No, that literally is happening, but there's different models out there.
Okay.
So you can have literally that, which is on premise where you're using that gas. It's a little bit tricky because you're, depending on how big of a oil and gas development it is, these wells have a very high initial production rate. Then it declines pretty rapidly, but it'll be there for 20 or 30 years. So as long as it's a pretty big well pad, but you are somewhat capacity constrained. The larger, more sustainable would be to have a localized gathering system to then transport it to a more permanent generation facility, which is going to be a gas turbine of some sort. Then that could be what's called behind the meter. So behind the meter means this is exclusively going to be used for powering this data center or this miner. But in certain cases, when power prices spike, or the grid really needs it, I can shut down and sell the power back. And so when Dallas froze, maybe normal energy prices might be 4, 5, 6, 7 megawatt hour, went to $9,000. So if you've got behind the meter and you're plugged into the grid, you're tickled. Like I'm selling that all day long. It makes no sense to run a Bitcoin mine. Mm-hmm. If you're off grid, it means you're not connected. So that's a little bit different where you can't fully monetize. But I know you've had other guests in the past, like Nick Carter, which have said this demand response adds a lot of durability to the grid. And it actually promotes renewables because these renewables would not be economic unless they had a base demand from that miner, from that data center. Obviously, it has to be supplemented by a non-intermittent source, particularly for data centers that need that continuous compute. But then also during times of peak, those renewables and those conventional fuels alike can then sell back into the grid and just harden that grid for times of extreme stress.
And when you could draw, let's say from scratch, the ideal scenario. So I go down to Texas, I find a place where there's a bunch of gas and I say, okay, I want to bring it to this kind of localized, collection center. I need to have some sort of gas turbine where I can, actually drive the power. I also want to be connected to the grid so that I can do the kind of demand, balancing. How do I store the gas between receiving it and actually using it for the power generation? Or is there some sort of kind of like just in time logistics where it needs to be here and I need to consume it within 24 hours before it loses its value to me? Today's episode is brought to you by Domain Money. I get asked all the time, Pomp, where should I go for financial advice? Now, as you all know, I can't personally give financial advice, but I now know people who can. Domain Money makes financial planning straightforward and accessible. They tailor plans to your personal priorities and goals, whether you want to buy a big house, whether you want to fund college, or you want to take that dream vacation. Now, I'm not a Domain Money client, and they are paying me for this ad, as you know. And I've seen firsthand, though, the value of their service through a free plan they did for one of my brothers. Him and I got on with one of their financial advisors, and they walked us through the whole process. It was awesome. Domain Money offers unbiased, flat fee advice with no minimums and zero misaligned incentives. They're not managing your assets or selling you products. It's pure, practical, and tactical financial guidance. Need more advice? They also pay by the hour options for plan updates or coaching sessions. Don't be like most people who have never had a real conversation about their financial plan. Trust Domain Money to help you build a clear roadmap for your future. It's hands down the smartest move you can make for your money. Book a free strategy session with Domain Money at domainmoney.com/pomp. Again, domainmoney.com/pomp. And yes, I might have an interest in promoting domain. So just like any major financial decision, it's important you understand what the service is and if it's right for you. So make sure to see the important disclaimer at dmnny.co/x. How about that? Go check it out today. Go to domainmoney.com/pomp.
Yeah. So if you're directly on premise, and especially if you have a larger facility and you're plugged into the grid, you don't really have to worry about storing that. You could have a compression facility, you could have a storage facility, but if you're behind the meter but plugged into the grid, you would be better off just selling that into the grid, even if it's at a couple cents per megawatt hour. But where it gets really interesting is where you could also install some wind and some solar, or you could even, better yet, you could outsource that to a third party who's incentivized to have greener types of power generation. They could have the same dynamics. So now you have a mix. You've got some wind, you've got some solar, you have some traditional. It's all behind the meter and you have demand response. So if you're a hyperscaler, and here's kind of one of the dirty secrets, let's just throw out a number. You have a massive 500 megawatt data center. If you have installed power of wind and solar of 500 megawatts, even if it only runs 20% of the time, you could say that you're green. Now, let's say you want to actually have something that is substantive. You could then take the emissions from your gas generator and then you could inject it back into the ground through carbon capture and underground storage. So now you actually are fully green and adding sustainability and durability to the grid while having non-intermittent power to fully power your compute.
You mentioned hyperscaler. What is that?
It's a catch-all term, but basically any of the massive tech companies that are doing very large compute search types of functions. And so that would basically mean your Amazons, your Googles, your Microsofts of the world.
Now, the Bitcoin miners, I think there's a lot of people in the Bitcoin community who understand what Bitcoin mining is. They've kind of caught on to this whole idea of gas flaring and building these facilities. They know Texas is a really big area. I think about 10% of global mining happens in Texas today. But then this AI stuff comes along. And now all of a sudden, everyone's very interested in all the energy that needs to be consumed by the AI facilities to be able to do all this compute for these hyperscalers, et cetera. Are these different facilities? What is like the similarities and differences between Bitcoin mining and, kind of the AI needs?
So there's very different needs. So at its core, they're very high electric and cooling intensive forms of compute. But I could direct people to the recent deal for Core Scientific and CoreWeave, where they're actually converting about 200 megawatts of existing, what was originally supposed to be Bitcoin mining, into HPC, high performance computing space. And so depending on the nature of the compute, you need to do things that make it suitable for GPUs versus these ASIC chips. You'd probably add security. You'd probably add durability in terms of vibrations, resilience in terms of if power goes down, fire. Because these GPU chips are worth a fortune. And so at its core, it's not that different, but then you would basically just need to spec out the facility slightly differently. And that's effectively what CoreWeave is doing with existing Core Scientific facilities. So
really, would it be fair to say that the Bitcoin miners, they consume the same energy, they, are still doing some sort of compute activity, but there's almost this like professionalization that occurs when it has to be the high performance compute because you're using hardware that's more expensive. There's maybe even potential to make more money in the high performance compute versus Bitcoin mining?
I like that comparison a lot. I think the one distinction though is that Bitcoin can power down when the grid requires or when economics dictate it, you're better off selling. And so that makes it a much more dynamic activity as opposed, especially if you're training these AI models, which mostly it's going to be training down there because you don't have to worry about latency. But basically these things are running trillions and trillions of computations. Then, they'll power down to save their work. And that actually, you go from this massive data consumption down to very low because they have to basically hit pause and save because you don't want to lose all that work. That's what causes brownouts in normal grids where everyone turns on and off their AC, right? So the resilience of Bitcoin by having that ability to be intermittent is a very big distinction between traditional cloud and enterprise compute, and then certainly AI and LLM compute.
So when I think of the traditional oil and gas, cowboy, if you will. I have a very distinct, Texas man who's walking out there looking at his oil field, whatever, right? Kind of like out of the, 1950s, 60s, 70s movies, right? When I think of a AI data center, I don't think of any of that. Are those two roles or people interacting with each other? Like the person who owns the land or is who, kind of involved in the oil and gas, exploration and extraction, et cetera. How aware or involved are they with like the high performance folks? Or is this like, you have somebody who kind of lays the foundation, somebody else who builds the house, somebody who lives in the house, somebody who, sells the house, but the person who lives in the house never meets the person who laid the foundation. And it's kind of like sequential, but not necessarily connected.
Yeah, it's exactly how you envision it. And a lot of these large landowners in Texas are ranchers. They're named ranches. And, there's some corporations, Texas Pacific Land Corporation, a new firm called Landbridge, where they're much more professional and they're actively accommodating the needs of these data centers. But basically, in the case of a company like Landbridge, they courted the ranchers. And they said, look, we have a higher and better use for your acreage, whether it be water infrastructure, data center, et cetera. They've acquired it. So now you have a very professional, investment-oriented manager dealing with the hyperscaler. And in the case of Landbridge, they've actually already pre-cleared 6 sites, which could have very large-scale data centers on their land. And they're just looking for kind of the first proof of concept. So
Horizon Kinetics, I think of you guys and I'm like, man, that is a firm that most people should aspire to build. You guys are first principles thinkers. You're very, very contrarian, not for the sake of being contrarian, but just in terms of when you come at it from the first principles standpoint. When I've told people about, what you guys have done over the years, I think people are very impressed. Unfortunately, I don't think most people know you like they would know, a Berkshire Hathaway or a Bill Ackman or anything like that. And so maybe give us kind of a crash course on, 30, 40 years in 2 minutes. But what is Horizon Kinetics and kind of like what has been this journey? Because you guys have actually been involved in a lot of these themes for a long time, just may not have been, all in anticipation of AI. It's just you guys kind of find yourself here now with the knowledge, the experience, some of the assets, et cetera, that put you in a good position.
All right, so I'm going to try to do this really quickly.
No pressure. Yeah. No one at the firm's going to watch.
So Murray Stahl, our CIO, and a lot of the credit for everything you just mentioned has to go to him. He was running a phenomenal investment strategy at Bankers Trust Company, which was a great private bank in its day. This is going back to the 1980s. It's since been acquired and absorbed by Deutsche Bank. Running a eclectic value equity strategy. And, the firm was changing in many ways and they decided that they needed to leave in 1994. He partners with Peter Doyle, Steve Bregman, who are still on the investment team with him, John Meditz, Tom Ewing, who are also part of the team, and said, we got to go start our own shop. So they leave in 1994 and they're like, exactly what you said. Let's do a first principle, deep value, Graham and Dodd, Buffett Munger, do what we want to do, not what a bank tells us to do. And I think that's incredibly important for firms today, and not enough people are doing that. So one of the first companies that Murray found a year or less after starting the firm was a Texas Pacific Land Trust. Back then it was a trust that had a little bit over 1 million acres of surface land and about 25,000 net mineral acres. And, basically he said, look, the land itself is worth a lot more than the market cap. They're selling land for more than the company is valuing the acres, and they're buying back stock with it. So that's this basically organic compounding machine. Oh, and by the way, we know there's a lot more oil there. They're probably going to figure it out one day. So that's a free call option. And that's really a lot of what we do is we underwrite a great business with a compounding element, but then get these free call options. Over the years, Murray's identified a lot of themes. He was very early in recognizing financial exchanges were going to just be money printing machines. He was very early in recognizing kind of globalization and kind of that pre-2008, 2009 period. And then, the firm kind of went through some different iterations. And then I want to say around 2013, I show up to this investment committee meeting, and I was fairly junior then. I'm worked my way up at the firm, and Murray sits down and tells everyone he read this white paper by this Satoshi guy, and I listened to him. Obviously, I respect everything he says, and I went home that night, like getting on the subway, thinking I might need to find a new job. I think he's lost it, but did more and more work. Spoke with Peter, spoke with Steven, put a little bit of my own money into it, just like pretty much everyone at the firm did. I listened and was very responsible, but a lot of people are sitting on 1 to 200x gains on what they originally invested. Mm-hmm. But you've had Peter on the podcast, so I won't repeat our thesis, which is very similar to a lot of other people. But then as crypto got more and more momentum, Murray said, look, I need to understand this mining thing because this is what underpins it all. So then he started a mining business, and that business is now called Consensus Mining. It's actually about to go public. But one of the principles of that company was, I'm not going to throw all this SG&A and pay all of these people, because you look at these public companies, all of your profit goes to SG&A and management. Mm. So, he basically absorbs those costs at Horizon to run a legit, I don't want to say legitimate, I want to say a profitable, like sustainable mining business. Mm-hmm. As the firm, again, as this is all evolving, we then recognize as part of our crypto thesis, our energy thesis, that the financial system is going to be getting more and more fragile to an inflation shock. And this is well before COVID. So COVID hits, and we decide to then kind of formalize our long-standing thesis on having hard assets into a product, which is a listed ETF called the Inflation Beneficiaries Fund, INFL, which I run, which owns companies like Texas Pacific, like Landbridge, all of these capital light hard asset plays with a lot of optionality on the future. And so I'd say kind of as you look at the firm today, so many prescient calls from Murray, but it's really comes down to how he kind of unpacks and his logic. And it's always about kind of understanding what your upside is, what your free optionality is versus what your downside is. And, you might think that would not necessarily take someone from analyzing a insurance company trading at half of liquidation value to Bitcoin. And, one of the things that people have said to me before is like, hey, Murray's one of the first guys with gray hair to like Bitcoin. And, this is almost a decade ago. And I say, yes, he might be on the older side, but actually he has a full head of non-gray hair, but that's besides the point.
Now, what is fascinating to me is these businesses that you specifically are looking at are public companies mostly, right? If not all, but they have hard assets. And so is that a bet on like long-term inflation, on long-term devaluation of the currency? Like how would you kind of talk about, our investment thesis is X, and that's why we ended up with these kind of, hard asset related businesses?
You want a durable business with something that's going to maintain value over the fullness of time. And I think that one component of it is a debasement of the currency and inflation. Another is that for a confluence of reasons, we've underinvested in a lot of these hard assets. Some of them, there simply just isn't enough capital to chase. If we really do go through these types of build outs, you look at certain raw materials and like we're not making more land. Copper is getting harder and harder to extract. We've radically underinvested in oil. So things like that, where you're saying, look, these are phenomenal assets long-term, regardless what your macro outlook is going to be. But then say, can we marry that with a capital light business model? So capital light means, am I actually going to earn these economic returns as a shareholder versus a CEO and management team that is incentivized to simply take all that cash flow to build an empire at my expense? And so that's really the core of what we're doing, is saying we want a durable portfolio that will compound over time, that is attached to these scarce, durable hard assets.
In those assets, you mentioned a couple of very different things: land, copper, right? There's things that kind of are across the spectrum. How do you evaluate what is durable, right? And there's been certain things that I think have been trends. Like, if you look at electric vehicles, maybe it's like the best example. There's all these minerals that everyone says, hey, they're really, really important. It is hard to see a world where that doesn't play out, given what we know today. But I guess maybe it's possible. There's been plenty of things over the last 40 years that people thought was going to be really big. You can look at green energy stuff where people lost a ton of money in the 2000s, and many other themes that people got excited about. They went and they sunk a bunch of money into it and ended up not actually being durable. And so I think the concept of durability, obviously everyone wants something that's durable, but how do you kind of go through an investment process or first principles thinking to identify what is actually durable versus what, sounds good today, but we don't know how this is going to persist over the next 10, 20 years.
Today's episode is brought to you by CrossFi. CrossFi is the Apple Pay for crypto. For the first time in history, anyone with a Web3 wallet like MetaMask can spend crypto through a physical or virtual Visa card anywhere in the world where Visa is accepted. No more exchanges or middlemen. Just link your wallet, get your card, and start spending today. CrossFi card transactions have already been successfully processed in New York, Los Angeles, London, Dubai, China, Japan, and over 20 other countries. Be one of the first to get your hands on a CrossFi card and a prize pool of up to $3 million by joining and participating in their testnet today. You can go to xfi.foundation/users. Again, that's xfi.foundation/users. Go check it out today.
So the two core tenets are, one, is it scarce? And by definition, if it's scarce, there's a limited supply response. So if I dropped $1 trillion out of the sky, it's going to be really tough to meaningfully change the copper balance in the world because these mines take 15, 20 years. Mm-hmm. I could throw $20 trillion out of the sky and you're not going to make more land. Mm-hmm. And we think that as a function of land, obviously food and agriculture is kind of a derivative of that. So part one is it truly scarce? If you meet that criteria, can it be substituted or replaced? And that one's a lot harder. And so the people that are underinvesting or underallocating to traditional energy sources today are saying, yes, we're going to fully displace oil and gas. I would argue that if you look at it simply from a physics standpoint, that is borderline lunacy. At the margin, can you have some incremental demand substitution? Yes. But if you think about the amount of things, like the amount of things in the studio, the plastics, the phone, the rubber in your shoes, the petrochemicals, forget transportation. So obviously transportation is carrying most of that. So then look at those two. So scarcity and then that inability to substitute. That's a great place to start. And that it makes it a much different dynamic than, you mentioned before, electric vehicles. So lithium's gone through this massive boom bust cycle where in theory, there's just a tremendous amount of lithium in the world. You could do these brines to get it out. There's hard rock. The Chinese are basically pumping the world with very low quality, but high cost lithium. And so I would argue that that's not scarce, but it's also can be replaced because you're seeing different chemistries in batteries, whether they're nickel based or cobalt based, et cetera. And so I think that's the beginning of the way to think about it.
Now, what is Horizon Kinetics doing with this intersection of Bitcoin, AI, oil, gas? Can you talk through the specifics of that?
Sure. So one of the legacy names, Texas Pacific Land Corporation, is a company we've owned for over 30 years as a firm. Murray sits on the board, and they've got over 800,000 acres in this region where we think there's a very large potential for data centers, and there's already Bitcoin mining. So that's a position that we love and have owned for years. A newer, more dynamic position that just came public. We were on the cover for about 80 million of the issue called Landbridge. They assembled about 220,000 acres in the Permian. Some of it's contiguous with Texas Pacific, but the private equity firm that is the sponsor called 5 Point Energy. I can't compliment the founder, David Capobianco, and then the CEO of Landbridge enough, Jason Long, where they have been very prescient in acquiring and consolidating the land, integrating it with their water business, and then pulling these value levers, whether it's fully outlining and delineating where you can put data centers, looking at where you can kind of get the egress for the power, looking at different ways that you can have redundancies in different infrastructure, but then also looking at different technologies like water desalination. So, this is something else we should talk about, which is that one of the biggest costs of a data center, about 40% of the overall electricity consumption, is for cooling. And the newest iteration of NVIDIA's chips in particular, but the entire industry is going towards liquid cooling or immersion. So liquid cooling can mean two things. So one is actually immersion, where you're basically putting the chips to keep them cool in a fluid solution. The other is using a circulated fluid and a cold plate to basically use that in lieu of a air cooler. Both of these combined can reduce energy costs for the cooling part of the business, that you can't really touch the compute side and you can't touch the other IT, maybe 70 to 90%. So LandBridge and TPL actually both have technologies to desalinate. There's massive amounts of water that comes out with the oil and gas from fracking. It's toxic stuff that historically, it was a liability. You'd have to remediate it, transport it, and then put it into a saltwater disposal well. Now, if you can economically desalinate it, now you can use it for your different liquid cooling. So now you're checking another box for Bitcoin miners and for data centers. So kind of looking at this, again, a full circle, you've got all this cheap gas, you've got an unregulated power grid. Now you've got the cooling option and you've got the cheap land. I'd say the last area that we touched on briefly was also the lack of population centers. So you're seeing a lot of backlash around the country about data centers, where Amazon's trying to co-locate with a plant, a nuclear plant in Pennsylvania. Two of the utilities are actually suing them and the plant itself because they're saying you're getting a free rider. So you're co-locating with this plant that's plugged into the grid. You're getting a free rider for basically the grid, and it's basically going to increase the costs for the grid and the community. So not sure exactly where that lawsuit, Talon's on one side, and I think you've got AEP, and I forget the name of the other counterparty that's suing them, but that's one issue. But, imagine you have brownouts. Imagine you have rising power costs. Imagine you have intermittency. So the fact that you're in the middle of nowhere is another massive advantage. And so whether it's LandBridge with their footprint, TPO with their footprint, just two really interesting assets in the basin.
When I think of a lot of American infrastructure, I think of bridges, roads, kind of the traditional infrastructure. But we live in this digital world, and the lack of data center capacity that we have feels like there is this entire infrastructure that the United States has to go build. How involved do you think that the government should or will be involved there versus it's more private enterprise and kind of the economic incentives? Will people who have land, people who have the ability to build this stuff, they'll be the ones to kind of solve this problem?
So on the utility side, most utilities and most rate-based utilities are heavily regulated. And so their returns on equity are regulated. They issue equity, they issue debt. And so the government's can do things at the margin to help them. But a lot of that's going to come through the private sector. Now you've got the CHIPS Act, you've got the Inflation Reduction Act, which is extremely inflationary. So they're definitely going to throw money at it. They by default have to be involved when you're talking about regulated utilities, but then there's two other areas we're talking about. So one is independent power producers. So these are power plants, which they're basically designed to only, so I mentioned earlier that event where it was $9,000 a megawatt hour in Texas. These peaker plants, so they're peaker because they only come on when the grid is peaking. So if you go above the reserve requirement of the regulated grid, they turn on their plant and sell it to you at these outrageous prices. That's actually one of the companies getting sued is actually one of these IPPs, independent power producers, where they're basically selling wholesale power and they're trying to do a co-location while being plugged into the grid. They can do things that the regulated utilities cannot, and that can be a lot of that funded through the private sector. But then to your point, I think particularly in Texas, because A, Texas is very business friendly. B, you have ERCOT, which is intrastate, so you don't have to deal with FERC and all of these federal agencies. I think you're going to see a massive amount of private capital coming there for that reason, and you're going to see kind of the best results.
Before I let you go, your offhand comment is one that I can't let you escape with, which is the Inflation Reduction Act was actually inflationary. I don't disagree, but explain to people how a piece of legislation that should be reducing inflation based on its very clever name actually had the opposite effect.
Yeah, I mean, look, the amount of money that the government is spending, we're spending 6-7% fiscal deficits in an economic expansion. So that's growing to $2 trillion. And so forget where all of the end uses are going to be, admirable as they may be, whether it's infrastructure or security or all of these other areas. If you're handing out what's effectively free money that's going into the private sector, that is going to be pro-inflationary, especially in a capacity-constrained economy when you're already seeing a big wave of onshoring. And so the more that you're kind of handing out this money, particularly when it could potentially be non-economic because it's a government grant, that has this kind of feedback loop of just adding to rising prices through kind of flowing through the economy. And so, net, I don't see how people have these views that inflation is going to normalize and or the economy is going to collapse when we're continuing to throw $2 trillion at it a year. There's going to be consequences at some point in time. I don't think the election is going to change the amount of the deficit. It might change the composition of where those dollars go. But net, this is just, money printing Congress forever until there's something that causes them to stop. And I think that really speaks to why you want to own hard assets, why you should certainly look at crypto, Bitcoin, and, things outside of kind of the conventional asset mix.
Politics is very easy to get tribal and kind of everyone picks sides, et cetera. But one of the things that I always remind people is, the debt has gone up under Clinton, Bush, Obama, right? We can just go down the line, every single one of them, both sides of the aisle. And it feels like it's structural. Like it doesn't actually feel like barring somebody who's willing to go in, rip the Band-Aid off, balance the budget, make a lot of people unhappy, know that they will be a one-term president, right? Kind of all these things that just naturally the incentives don't, push towards. You don't see it stopping. And in that case, I think you're right. It's like, if you believe that this will continue on the path that we are, there are some very obvious things that you should own. First of all, you should not own dollars, right? You should own hard assets. You should own things like Bitcoin. Equities also, I think, have become this kind of inflationary, kind of hiding ground. I think a lot about like historical valuations may actually not be a great guiding, path today, because there's this like monetary premium now that equities have, because people are using the stock market to kind of insulate themselves from inflation. And so when you start putting this stuff together, you're like, yeah, maybe actually investing is all about just understanding like this one trend, and it will drive a whole variety of assets higher. And if you get that one thing right, you're probably better off than, anything else you could get right.
Yeah. It's funny that you mentioned that. Just the amount of macro noise that's driving everything else has just been so strong for almost a decade now. And it's only been ratcheted up. But to your point, if we're just going to print like this, and now I would argue, so the Federal Reserve technically has two mandates: price stability and full employment. I would argue they've added a third, which is financial stability. So they've stepped in every time you've had something. They don't really care about equities, but when you have an issue could be systemic. They bailed out Silicon Valley Bank. They didn't have to. They got involved in reverse repo before COVID. They went ballistic during COVID. So you've seen it in the UK when LDI blew up the gilt market. So if you have no moral hazard, and if you have the Fed willing to step in when there actually is a market disruption, and you have $2 trillion of money printing, that by definition is going to be positive for risk assets. Mm-hmm. So I think it's more just thinking about what assets will do the best. And I think the one caution is, I think there's a lot of zombie assets out there, for a lack of a better word, because clearly if we're going to be running this kind of policy, it's going to be really, really tough to get inflation sustainably back to a number that's palatable. I think that they're going to implicitly, not explicitly, change the target. But that means rates are going to stay higher. Are they going to stay this high forever? Who knows? But there's a lot of assets that were underwritten at 2-3% cap rates and that had these massive exit multiples. I'm talking venture capital, real estate, private equity that might never get those value or might take years or decades to get those valuations again. So there's a rate sensitivity component I think that people need to consider, but otherwise I completely agree with your premise.
Yeah. I really enjoyed this. I think that it's this very interesting dynamic of, kind of where we started. It's like the old world has to interface with this new world. But maybe that's the wrong way to look at it. It's actually like the new world better figure out how to work with the old world. And I think a lot of technologists, a lot of even, finance folks, et cetera, they like to kind of thumb their nose and say, hey, we're disrupting something, we're doing something new, et cetera. But I think you guys are a perfect, example of if you understand history, if you understand, kind of the time tested, strategies for investing and kind of value accrual, there's a lot of opportunities still out there. And in a world of software and, kind of this like high leverage, kind of no hard asset, asset light type business, whatever, you can still make a really, really good return by going and finding, these hard assets and kind of doing the work that you guys do on a day-to-day basis. So it's pretty cool to see that.
Yeah, thanks. Look, we think we're doing some interesting things. And what you just mentioned reminded me of a great line. It was Jeff Curie when he was at Goldman running their commodities business. Now he's at Carlyle, but he calls it the revenge of the old economy. And I feel like that's really what it is. All these new things cannot happen without the old economy. And so figure out a way to make money from that.
I love it. Well, thank you so much for doing this. We'll definitely do it again in the future.
Yeah, this has been great. Thanks for having me.